everybody. Welcome to Accounting Superstars. I'm glad you're here. This is a place to learn accounting, and I've got a lot of fantastic ways to explain it. I've been teaching accounting for 30 years. I'm a professor and a CPA. Let's get started. So here's what we're doing today. If you can learn the basics and get a good foundation, the rest of accounting is easy. It's a piece of cake. It's not that hard. But get a solid footing on the foundation and you will do great. So here is the most foundational foundation there is in accounting. It's the accounting equation. It's right here. It's easy. Assets equals liabilities plus equity. Well, it's easy if you know what assets and liabilities and equity are. What's an asset? I like to use just a very, very simple definition of assets when starting out. Assets are nice things to have. All right, I know that's not totally accurate, but it'll work for now. So assets are nice things to have. So let's suppose that we are a construction company. What would be some assets? Well, having some cash, that'd be a nice thing to have. Having a pickup truck would be nice to have. Having some tools would be nice to have. So all these things are assets. Having some lumber might be a good thing to have too. Some inventory. There are a lot of things that are nice to have. So what about liabilities? Liabilities are bills. What kind of bills? Taxes. Maybe you owe your suppliers. Maybe you owe your workers. Got to pay some fees or whatever. It's anything that you owe. And finally, equity. So what is equity? Equity goes by different names. Equity is also known as net worth, owner's capital, things. So don't let the words confuse you. It all means equity. And it all works the same too. And so what is equity? Well, I think the best way to figure it out is to look at an example. So here we go. Here's our example. So what is equity? Let's suppose that you bought this old rusty car, and let's pretend that it's worth $500. And maybe it looks awful, but it runs fantastic. But let's also suppose, just for the sake of example, that you bought the car on credit, which is really a dumb idea. And you owe the used car lot $300 for your car. All right, so that's the liabilities. So what this means is your equity in the car is $200. And it's just simply on the left-hand side, $500, and it's got to equal with the right-hand side, $300 you owe, so therefore equity must be $200. So what if this car was somehow a classic and was worth $1,000? And let's say that you still owed $300 on it. Well, now your equity is $700. So equity is kind of a residual amount. The way I like to think of it is that all these nice things that you have minus away what you owe is your equity. It's just that simple. Well, let's say that this car, it's rusted on the outside, and let's say it's worse on the inside. It doesn't even run. You can't even get it started, and it's probably worth only $100. And let's suppose that you still owe that used car lot $300. That means you're in the hole. Your equity is negative because this accounting equation's got to hold. The left-hand side's got to equal the right-hand side. So this $100, it's got to balance with this here, and it does. Liabilities minus that negative equity equals $100. So $100 on the left, $100 on the right. All is good. So let's go on. Let's do an accounting equation for ourselves. Let's suppose that we're in college, we're an undergraduate, we're living in the dormitory. Let's see what our accounting equation is. We all have one. I've got one, you've got one, your mom has one, your dad has one, your family has one, the federal government has one. So you can figure it out for yourself. And that's a good reason why you ought to know a little bit about this accounting equation. Is whether you like it or not, you've got one, so it might be good to understand what it is. So here are some things that we have. A lot of these are nice things to have here, like it's nice to have a car and a basketball and gym shoes and so on. And some of these other things are not so nice to have, but I'll show you how this works. It's easy. So let's suppose that we have that car from the previous example, and that car is worth $500, and you still owe $300 on that car. And so therefore, your equity in the car is $200 because 300 and 200 equal 500. So the left side equals the right side. Let's say that you have a basketball and it's a very nice basketball and you paid a lot of money for it. It's a beautiful leather basketball and it probably cost at least $100. But if you were to try to sell it right now, since it's used, it's probably not worth a whole lot. In fact, you probably would only get maybe 20 bucks for it. All right. So, and let's say that you don't owe anything on this basketball. It's fully paid for. And so your equity in that basketball is $20. So the left-hand side equals the right-hand side. And the totals equal too. The left-hand totals equal the right-hand totals. 520 equals 300 plus 220. Gym shoes. Let's say you bought the finest gym shoes ever made. They cost at least $200, maybe $250. I have no idea what they go for. But they're used. And since they're used, they're probably not worth very much. Maybe you could sell them on Craigslist or something. I don't know. But let's say that they're worth maybe $30 now. And you don't owe any liabilities on them. And so your equity would be $30. How about that empty keg of beer? Well, it'd be nice if it was a full keg of beer, but it's an empty keg. And let's say you can get back your deposit on it. So that keg's worth about 40 bucks. If you take it back to the store, they'll give you $40. Return your deposit on it. And you don't owe anything on it, so your equity is $40. Now, let's suppose that you have some credit card debt. Not a lot, but some credit card debt. And let's say that you took all your friends out for pizza and beer, and you said you pay for everybody's dinner. You actually have nothing to show for your credit card debt because all that food has been eaten. For assets, we'll put 0. But you owe $200 for being such a nice person to all your friends. And so what are we going to do about the equity here? The left-hand side has got to equal the right-hand side. How are we going to make that happen? We can't put anything over here for assets. Nothing here at all because you have nothing to show for it. The food's already gone. It's been eaten. You don't even have any leftovers in the fridge. Equity is going to have to be a negative 200. Well, here's how this works. The liabilities are 200 and your equity is negative 200. So these two cancel out and make 0. And the assets are 0 too. So the accounting equation actually does balance. 0 equals 0. And the totals equal too. $590 on the left, $590 on the right. So everything balances. Now student loans here. Now your student loans, let's say that you owe $10,000. What did you get from those student loans? Well, you got a lot of promise and hopefully it'll reward you in the future. You'll get a good job. But as of right now, you don't really have anything tangible to hold on to, except for probably those old used accounting books. And used accounting books don't sell for much. So let's say your accounting books are worth about $50. I know you paid a lot more than $50 for your accounting book, but when you turn it back in, you won't get nearly as much as you paid for it. Let's say that's all you have to show for that $10,000 student loan. And of course, you might be saying, hey, well, I'm making an investment in myself, and that's a good thing to have. And you're exactly right, it is. But in accounting, there are certain things that we don't count as assets. Earnings right now are kind of uncertain. So we'll just leave the assets at $50, the value of your used accounting books. So what that means is in the equity side here, we're going to have a negative 9,950 here. Liabilities, 10,000 on the student loans. And that negative 9,950, if you net those two together, you get a positive $50. That's what those accounting textbooks are worth, about a positive $50. And cash here, let's say you've got $100 on you. That's all you got. And you don't owe anything. That's your $100. And so your equity in that $100 is $100. So check it out. The accounting equation still balances out. So here you go. The accounting equation still balances. 940 on the left. If you were to net the 10,500 under liabilities and a negative 9,760 for equity, it would all balance. So anyways, is having a negative net worth or a negative equity a bad thing? Well, if you're young and just starting college and just getting going, it's not a bad thing. You're investing money in yourself here with your student loan. If you were my age and had a negative net worth, that would be a very bad thing. Retirement would not look too sweet.